Hi, folks. On today's episode, we will be going over a dynamic banking scenario for an awesome educator up in Portland, Oregon. She's hoping to retire in 8 years or so, and we want to make sure that she can have all of her debt paid off by the time she's ready to retire. We're going to go over the whole plan in detail, including how our average daily balance is affected month after month. So stay tuned. We've got a lot of information coming your way. More wealth, less cash, fast. Oregon Cash Flow Pro. Let's start with a brief overview of the plan. So with dynamic banking, we are looking to maximize our cash flow by funneling all of our income for a month through a line of credit. And then from the line of credit, we're paying our bills. We're not letting our funds sit in a checking or savings account at any point during the month if we can help it. Money that's sitting in a checking or savings account, for the most part, is earning you zero benefit. Meanwhile, you have loans out there that you're paying interest on. So this method will maximize your cash flow. Take a look here. Our teacher in Portland, between her and her husband, we've got $7,500 in income, $5,500 in expenses, $305,000 debt, and about $2,000 cash flow. Now, these numbers are rough numbers. She didn't have her exact budget figured out, but I figure after taxes, their income is about $7,500, and they were thinking $4,000 for monthly expenses. So I pumped up another $1,500 each month just for having fun, vacations, being able to enjoy your life while you're trying to pay off all of your debt. So realistically, there's a number of reasons that this plan could end up being paid down a lot faster than what we're anticipating here today. But a lot of that will just depend on how closely somebody can stick to the plan and how aggressive they are in saving on their extracurricular expenses. Moving on, we've got a truck payment, $505 a month, $33,000 balance at 5% interest. We have a trailer payment, $231 per month, $22,000 balance, 4.5% interest. We have a mortgage, $1,229.81 a month, 4.25% interest, and $250,000 balance. Now, again, these numbers are approximates. Okay, so our educator friend has not got her line of credit yet, but she has excellent credit. I don't anticipate she will have any trouble getting a line of credit. So I'm defaulting to a line of credit. I'm recommending she gets about $25,000 line of credit. Her interest rate will likely be better than 6.25%. Again, that will lead to a quicker payoff than what we're anticipating today. But I had to have some numbers in order to make a plan here so she can see the value in dynamic banking. So to finish off the plan here, we've got paychecks going into a line of credit. We want to be sure to use a rewards credit card for as many daily expenses as possible. The reason being, this is interest-free money. If you pay it off each month, you will not pay any interest. So it helps us to keep the average daily balance on that line of credit as low as possible, leading to the lowest possible interest charges each month. Let's look at this in action. So we've got a $12,000 balance. We're going to do a chunk of $12,000 towards the truck loan to start off this plan. You can see we've got a $12,000 balance on day one. Day two, we get our paycheck that gets deposited. Midway through the month, we make our mortgage payment you'll see this is higher than what we show on the other screen. And that's just because this includes taxes and insurance. And down here at the end of the month, you will see our credit card charges getting paid off. And our final balance at the end of the month, after our $2,000 cash flow, $10,000. So we started at $12,000, we're down to $10,000, but the magic happens in between those numbers. So let's take a look. You can see our average daily balance over here. It starts off at $12,000, goes down below $5,000, jumps up a bit, and then gets back up to $10,000 at the end of the month. Our average daily balance, $5,839.68 in this scenario, for an interest cost of $31 for the month. So we borrowed $12,000 and we paid $31 of interest that month. Month number 2, we've got our $10,000 starting balance. Same scenario, we get paid, we make our mortgage payment, and at the end of the month, we have an $8,000 balance. But our average daily balance this month is $3,839.68 for an interest payment of $20.38. You can see it in graph form here. We start out at $10,000. Our paycheck goes in, make our mortgage payment, pay off the credit card, and we finish off at $8,000. Month 3, we start off at $8,000, yada, yada, yada. And at the end of the month, we're down to $6,000. Average daily balance, $1,839.68 for an interest charge of $9.77. This is amazing. Take a look. $8,000, paycheck goes in, mortgage comes out, credit card comes out, and we finish off at $6,000. So we essentially used $8,000 throughout the course of that month for $9.77. Remember, that $8,000 was put towards the truck loan. So we shifted $8,000 from that truck loan into the line of credit, and it only cost us $9.77 for this month's worth of interest. So let's tie this all back together. We use our rewards credit card for our daily expenses. Our paycheck goes into our line of credit. Our regular expenses come out of the line of credit. To start off with, we chunk $12,000. There's our paycheck going in, expenses coming out. End of month 1, we're at $10,000. Same thing happens. End of month 2, we're at $8,000. End of month 3, we're at $6,000. And at the end of that month, we make our next chunk again. We had $6,000 chunk. Goes back up to $12,000 and the process repeats. Okay. Now there's a reason that we're only doing $6,000 chunks and we're only going up to $12,000. One, it leaves us a lot of room. If our line of credit is $25,000, that leaves us $13,000 in case of emergencies, because we are not putting any money towards our savings right now, right? So we have to have money in case of an emergency. That happens by doing smaller chunks. The other reason for the smaller chunk is the truck loan, the trailer loan, and the mortgage all have a lower interest rate than our line of credit. So if I were to throw a huge chunk from the line of credit, if we were to do $25,000 from the line of credit, we're going to end up paying more interest than we would have if we had that money sitting for the truck loan. The benefit to utilizing the line of credit is to run it as close to the amount of income you're going to put in each month as possible. That's how we minimize our interest charges when the interest rate on the line of credit is higher than the interest rate on the loans that we're working to pay off. Now let's look at what happens. With the truck loan, we end up with a payoff month 10, total interest on the truck loan, $620.87. We end up with a payoff in month 17 of the trailer, total interest paid on that loan, $1,128.95. And we end up with the mortgage paid off month 89. That's 7.4 years, folks. 7.4 years. Total interest, $47,778.97. Now, our total interest on all three loans ends up at $49,528.79. This doesn't include our interest charges for the line of credit. In this case, our line of credit at most will end up with $3,968.79, because the way that I do all of this math, I don't actually know what the average daily balance will be based on when the expenses come out of it. So $3,968.79 is not taking advantage of the paycheck offsets. If we actually get the paycheck offsets in there and maximize them, like I showed on the other screen, our interest charge is going to be close to $1,800. And if we only get a marginal benefit from it, we're probably going to end up with around a $2,500 interest charge for the 89 months that we use this line of credit to pay off all of these bills. So look at this. Here's our original payoff. If we make minimum payments, our original payoff on the truck loan, 77 months, $5,600 in interest. Our payoff on the trailer, month 119. This is making minimum payments, folks. Interest charges, $5,267.93. And our payoff on the house, 360 months, that's 30 years, $192,745 worth of interest. So our total interest saved by doing dynamic banking and running that paycheck through the line of credit, a whopping $154,000. And we pay it off in 7.4 years. That's the math, folks. This is amazing. I hope you're able to understand that. Check out our other videos. If you need a little bit more insight, you can fill out the form below, and I'll be glad to put your scenario in a video and put it up on YouTube and help you take control of your finances. So be sure to like the video down below, subscribe to our channel, and let me know if you have any questions. Put them in the comments below. Happy to answer them for you. Thanks for watching. Have a great day.